I'd like to welcome today Phil Grant, Managing Partner at boutique accounting firm Nexia ASR, and we'll talk more about money matters and the entrepreneur. Good morning, Phil.
Hi Fiona, how are you going?
I'm good,
Excellent.
I'm good. Phil, today I'd like to look at what happens to an entrepreneurial company when it's in a fast growth phase. I mean, everyone who does a startup, they write their business plan and they really hope that will happen, but usually that's not the case. Though, if it does happen, it's an exciting time, but there are some pitfalls also, aren't there? Can you maybe sort of highlight a company gets out of the blocks, it's all working and it's going really fast. What are some of the things that could sort of be problems?
Look, I think the first thing that you've got to do in that space to avoid any problems is you've got to be dynamic. And so you've got to be able to change direction quickly. And I think, hopefully in a lot of startups, you don't have a massive workforce, and so it's typically the founder and maybe a few others, and there has to be a strong collaborative effort and understanding that, you might have to change direction quickly. Having said that, planning's critically important, and I'm not talking about multi-page documents of business plans, but really one-page plan approaches of knowing where you are now, where you want to be, and then having clear strategies to get you to the next stage. And it may well be that if it's really moving quickly, you need to take stock on a regular basis and just reassess those plans. It may sound a bit sort of controlling to have to do that, but I think you need to always know where you're heading, or else you can't quite see what's ahead of you. And you've got to be able to see, you've got to get visibility about what's ahead of you so that you can then plan your next move. There's always going to be things that come up you don't anticipate. That's the beauty of it in many respects. But I think you need to have a clear plan. Having said that, you need good people around you to support you. Whether that's internal or external advisors, you need to have good people who are around you who maybe have got some experience that can help you anticipate what those roadblocks or issues are going to be so that you can plan, so you can at least have a thought about, well, what am I going to do if this happens, and what are the likely implications of these actions. So I think that's really what you've got to do. Now, there's no ironclad guarantee. There's no doubt you're going to get yourself into problems, but with a startup business, that's all part of it. It's, I guess, the risk and the reward sort of scenario where there's risks, and part of those risks is the unknown. And hopefully the rewards are substantial as a result of taking those risks.
Phil, I've certainly noticed that when we were in periods of fast growth with Arts Hub, that actually we're in a good position. We had a surplus cash, but there's always a temptation then to go and get a little bit more diverse and use that cash in other ways. And the plan really is the discipline to stay on track and just keep making good money and looking after your customers and not going too far sideways. Would you say that's a sort of common pitfall that many businesses could be tempted into falling into?
The word that comes to mind is distracted. You get distracted or you lose interest and think, oh, well, I've done that, what's next? And I think you've got to be confident that you've bedded down what you've got. But I think you also need to have an eye for what's next. So the pipeline, what's in the pipeline. And I think that's where this planning is critically important. You need to say, okay, it's good to have a pipeline. I think it's critically important. That's part of the visibility about the future. And pipeline of ideas or innovations is, I think, critically important. But I think they need to be carefully scheduled and managed. So that you don't end up just simply saying, oh, we can just do that, and you ignore all the good work you've done behind in the past, and all of a sudden you think, oh, geez, I've got this idea up, but the last one's fallen over, and so you're always tripping yourself up. So there's got to be discipline to make sure that you stick to the plan, but have an eye for the future also. And I think that's, you've just got to manage that, and it may well be that you can see all these great ideas, but you just don't have the resources, which is typically the case, to actually go and do the next stage, or the resources being people and money. And so, you just have to be patient. And I'm sure there are plenty of business out there which will counter that and saying, oh, well, we just run off and do it. That's fine. and there's going to be a certain success rate from that. But I guess what we're trying to do, we're trying to design it so the success rate is higher. And I think by having a well-planned process around it, I think that's going to give you a better success.
Phil, I used to work for a government agency in WA called the Small Business Development Corporation, and we often had small businesses come in and ask for various types of advice, and commonly those that were in fast growth had a cash flow crunch. And there were many reasons, but you know, for many it had to do with servicing all the new clients they were able to get in cost more than the money coming in the door. The money was delayed. What do you do if you're actually growing well, or the numbers look good, however the cash in the bank is going to hit negative?
Look, I think it comes back to planning. You need to be able to have that visibility and know that that's the case.
Mm-hmm.
And
then what do you do?
Well, you need to access the resources, mm-hmm. and that's the finance resource to fund it.
Yep.
I mean, growth has to be funded. And, you know...
Is that bank finance, equity finance?
It could be. Look, you know, it could be bank finance, and I'm sure all of us have done it, where you've hocked the house and hocked everything and you've got nothing left, and so it may well be that you go to the bank and the bank might not lend you any more money. You go to, you know, the VC firms and they might say, look, you're too early or too small or too much risk, so you can't go there. It may well be that you go to the next door neighbour and say, I've got this great idea, and he backs you, and you give away some of the farm in order to do that. Now, I guess, you know, you've got to measure that, and you know, you might be, or it may be delaying the decision until, in fact, you've built up your business, you've generated a bit more earnings where you can actually afford to reinvest them in the business. Because ultimately, if you know, by taking that decision, you might end up hanging on to a greater piece of the pie. If you jump a bit earlier, you're giving away some of the farm. But on the other hand, if you wait a bit longer, you might lose the momentum and lose the opportunity. Somebody might take the idea. So you've got to balance all those things up, and you've also got to understand, well, where am I heading? What am I trying to head towards? But the critical part to this is being good at what you do and not neglecting what is your core business. And so you've got to really examine whether what you're proposing, it might be great, but is it really about what you do? You know, might be a separate business idea completely, which needs a completely fresh business plan and set of capital attached to it, you know.
Fast growth doesn't usually last forever. So what are some of the things a business can do in that time to make sure it doesn't suffer too much later down the track, when the business returns to more normal and expected growth pattern?
Well, I think it comes, you know, I'll just keep on saying it, planning, because I just think that's so important. It's sort of understanding that, you know, businesses have peaks and troughs. You know, there are times when, you know, the resource that you needed to build a business, which is the investment, are heavy and the cash commitments are heavy, but we actually end up with a position where we know that will plateau, and, you know, we'll all of a sudden start to get a return on that investment. And I think, you know, you've got to, in your planning, be clear on what your acceptable timelines are, plus or minus, you know. And once you have that clarified, you need to sort of monitor that. But I think, you know, if we all had 20/20 vision of exactly what's going to happen, you'd say, well, it's going to cost me X million dollars to build this. I've got all the money set aside to fund it. I'm prepared to make that investment. And at the end of that investment, I know that I'm going to get a return of 25, 30, 40%, whatever the acceptable benchmark for you is as the founder. And when you get to that point, and when you start to deliver, and your business is restored to its strong cash flow because you're no longer investing, that's an acceptable return for you. So I think, you know, it's about being realistic with your expectations. I think a lot of startup businesses don't have that clear vision. They just go about, you know, running, looking down and not looking ahead, which is what you've got to do. You've got to look ahead. Thanks for your time today, Phil. Thanks, Fiona. I've been speaking to Phil Grant, who's Managing Partner at Nexia ASR, and we've been talking about money matters and the entrepreneur.